Hey, audit adventurers! Welcome back to Audit ABCs with Jess, the place where we break down audit standards in a way that actually makes sense. Today we're diving into a big one, ISA 320, all about materiality in planning and performing an audit. Think of it like this. If auditing was baking, ISA 320 helps us decide which ingredients matter and which tiny sprinkles we can ignore. Imagine you're baking a cake. If you forget a pinch of salt, no big deal, but forget the flour, total disaster. Auditing is the same. Some things matter more than others. That's where ISA 320 steps in. It helps us decide what's important enough to affect decisions made by users of financial statements. That's materiality. Here's an overview of items that we are going to discuss. So let's start with the basics. What is materiality? Materiality is about significance. It helps auditors decide what matters enough to affect users' decisions, like investors, creditors, or regulators. If a company makes 1 million Rand a year, a 5 Rand mistake won't change anyone's mind. But a 50,000 Rand overstatement, that could definitely mislead someone. ISA 320 says, misstatements, including omissions, are considered to be material if they could influence the economic decisions of users taken on the basis of the financial statements. So it's not just about the size, it's about the impact. Materiality is a game changer for 3 reasons. 1, it helps us focus our efforts. We audit what matters most. 2, it helps us set thresholds for errors. 3, it helps us evaluate results at the end. If we didn't use materiality, auditors would be wasting time chasing every single cent. There's not just one materiality number. We actually calculate 3 types. Let's zoom in on each type of materiality and a quick example of how to use it. 1. Overall materiality. What's the maximum error we tolerate before it misleads users? For example, if the profit is 5 million Rand and we say 5% is our benchmark, planning materiality equals 250,000 Rand. Number 2, performance materiality. Let's set the bar lower to catch more errors before they pile up. ISA 320 recommends using less than overall materiality to reduce risk. For example, if we set performance materiality at 75% of overall materiality, then performance materiality equals 187,500 Randi. Key factors influencing the percentage you choose. It is all about the risk of misstatements being undetected or uncorrected. The higher the risk, the lower the percentage. Factors that raise risk. History of misstatements, weak internal controls, complex accounting estimates, high volume or subjective transactions. For example, if a cake company has messy inventory controls, you may set performance materiality at 60% of overall materiality instead of 75%. Number 3, tolerable misstatement per account. Now we break it down by area, like sales, payroll, inventory. Tolerable misstatement tells the auditor how much error can be tolerated in each account before it's considered significant. While performance materiality is applied at the financial statement level, tolerable misstatement is a practical tool used to plan and perform audit procedures at the account or assertion level. To calculate tolerable misstatement, you divide the performance materiality across accounts based on their inherent risk and relative size. There are 2 common ways. Firstly, the proportional approach. Allocate tolerable misstatement based on account size as a percentage of total assets or revenue. For example, sales is 20 million Rand, which is 50% of total revenue. Inventory is 3,500,000 Rand, which is 9% of total assets. Then assign 50% of performance materiality to sales, 350,000 Rand, and 9% to inventory, 63,000 Rand. But this method alone ignores risk. The second method is the most preferred method, which is the risk-adjusted allocation. Take your answer in option 1 and adjust based on risk and audit focus. A high risk results in a lower tolerable misstatement, and a low risk results in a higher tolerable misstatement. Here is a quick example. Important. The sum of tolerable misstatements can, and often does, exceed performance materiality. Why? Because you don't expect all accounts to be misstated at the same time. It does not mean that component is materially misstated. The purpose is only to serve as an indication that this item is a risky area and more testing needs to be performed. Think of performance materiality as your overall budget, say 700,000 Rand. But you can't go shopping for the whole company with one wallet. So you break that budget down per department. 280,000 Rand for sales, 70,000 Rand for inventory, etc. That way, each team knows its limit, and you can spot where overspending, misstatement, happens. ISA 320 does not explicitly require you to allocate performance materiality to individual account balances. However, skipping tolerable misstatement increases the subjectivity and risk of overlooking an individually material misstatement in a key area, insufficient documentation for your audit judgments, not detecting cumulative misstatements until too late. Apologies for interrupting your awesome session. I would just like to remind you that if you find this helpful, please like and subscribe to my YouTube channel so that you don't miss out on many more audit matters to be explained and discussed. Thank you for your support. Okay, let's talk about the golden question. How do auditors choose the right number for materiality? Well, we don't just guess. Auditors use benchmarks. These are reference points based on financial data that help us anchor our judgment in something measurable. But it's not always so cut and dry. We have to consider other factors that influence these benchmarks too, such as entity type, profit versus non-profit, government, charity, volatility of numbers. Profits may swing wildly year to year. Users focus. Are stakeholders more interested in assets or profit? Loss-making entities. When profit isn't reliable, use revenue or assets. Let's use the baking industry as an example in considering the factors discussed. Let's consider the first factor, the entity type. Is it a for-profit, non-profit, or government entity? Jess's Custom Cakes is a for-profit bakery, specializing in high-end celebration cakes. Since it operates for profit, the auditor selects profit before tax as the benchmark. The rationale behind this choice is that profit-driven entities prioritize bottom-line performance users, like investors or owners, who care about net earnings. Now, volatility. Are profits stable or fluctuating wildly? For example, the Cake Project, which is a bakery that donates cakes to underprivileged communities, sometimes runs at a loss and relies heavily on donations. Its profit swings dramatically from year to year. The auditor uses total revenue as a more stable benchmark than profit. The rationale behind this is that when profit is too erratic or negligible, revenue gives a better base for materiality planning. User focus. Do users care more about profit, assets, or revenue? Bakers United, a cake franchising business, is being assessed by potential investors. These users are most interested in profitability trends. The auditor chooses profit before tax as the benchmark, with the rationale that since decision makers are investor-type users, materiality should align with metrics they value most. Loss-making entities use revenue or assets when profit isn't reliable. For example, Sweet Start Cakes, a new bakery startup, has operated at a loss for its first 2 years due to high startup costs and marketing. The auditor uses total assets or revenue as the benchmark. The rationale is based on the fact that there is no meaningful profit to base materiality on. Alternative benchmarks are more appropriate for early-stage entities. Risk and complexity. Higher risk? Use a more conservative benchmark. Cake Chain, an international e-commerce cake company, operates in multiple tax jurisdictions and has related party transactions with suppliers. The auditor uses the lower end of the benchmark range, e.g., 5% of profit, or even considers specific thresholds for high-risk areas like related party purchases. The rationale is that a higher audit risk requires a lower materiality to catch smaller, potentially significant misstatements. Below is a table that summarizes the relevant factors together with impact on planning materiality, entity type. This factor guides us whether to use profit, revenue, or assets. Volatility. This ensures that we select a stable benchmark like revenue. User focus. This factor aligns the benchmark with the user decisions, investors, lenders, etc. Loss-making entity. If the profit is unstable, we use revenue or assets. Lastly, risk and complexity. This factor justifies using lower percent or special thresholds. The exact percentage selected is influenced by a number of qualitative and quantitative factors. Please take your time to familiarize yourself with these factors as listed below. While the standard doesn't give exact numbers, audit firms, regulators, and academic research have observed commonly accepted ranges used in practice. So, why these ranges? The benchmarks are used because they strike a balance. They are low enough to catch significant misstatements. They are high enough to avoid over-auditing immaterial items. They are defensible in court or regulatory review, backed by industry norms. Please note, you are not required to use only those benchmarks cited in ISA 320. You must use professional judgment and ensure that your choice of benchmark is justifiable, consistent with the nature and context of the entity, and documented. Apologies for interrupting your awesome session. I would just like to remind you that if you find this helpful, please like and subscribe to my YouTube channel so that you don't miss out on many more audit matters to be explained and discussed. Thank you for your support. Let's say we're auditing Penny's Pastries, a bakery with 10 million Rand in annual revenue and 1 million Rand in profit. The company is a low-risk company with proper controls in place. We therefore decide the most appropriate benchmark is profit, since the company is a for-profit entity and the profits were stable during the past few years. Based on this, the overall materiality is calculated as 10% of 1 million Rand, which equals 100,000 Rand. Since the company is a low-risk company, we can lean towards a higher percentage. The company's internal controls are stable with limited to no misstatements in the prior year. Therefore, performance materiality is set at 80% of 100,000 Rand, which equals 80,000 Rand. Tolerable misstatement limits are calculated as sales, 45,000 Rand, expenses, 30,000 Rand, inventory, 35,500 Rand. These amounts are calculated in the way explained earlier. Sometimes even small errors are material, not because of size, but because of nature. For example, a 100 Rand bribe is material. A 50 Rand error in director's salary is also material. Hiding a related party transaction, that's very material. ISA 320 says, misstatements may be material due to nature or circumstances, even if they're small in amount. Materiality isn't set in stone. If we discover something significant, like a hidden loan, we may need to revise materiality to reflect the new risks. One error may not be material on its own, but together, small misstatements can add up. ISA 320 reminds us to always consider the cumulative effect. Sometimes we apply lower materiality for specific items that are sensitive or risky, like related party transactions or director's pay. Why? Because users care, even if the amount is small. Here are the key takeaways. Materiality helps us focus our audit. We use overall performance and tolerable levels. Size and nature matter. Setting the right level is part judgment, part experience. So next time someone asks you why auditors don't catch every tiny mistake, you can say, because not everything matters, and ISA 320 helps us know the difference. If this video helped bring clarity to materiality, give it a like, drop a comment, and let me know. What benchmark would you use in your next audit? Remember to subscribe so that you don't miss our next topic. ISA 330, an auditor's response to assessed risk. Until next